The deficit will go up over the next 10 years significantly, as high as 7% of GDP. So how are we going to finance that? Well, we have financed it, I would say, through our basically importing capital from the rest of the world based on our avid consumption. They hold a lot of that debt. Will they continue to buy that debt? That's a big question mark now.
You said earlier that trade wars and any wars, they escalate to the point where somebody breaks. If you had to guess, what would happen? Who's going to break first? Is a recession pretty much guaranteed at this point, or can we escape a slowdown? We're talking about economic growth, the prospect of inflation, and what the FOMC may do next with our next guest, who's an expert on all of these areas, Thomas Hoenig, who was formerly the president of the Kansas City Fed from 1991 to 2011, former vice chairman of the FDIC from 2012 to 2018, and currently the distinguished senior fellow at the Mercatus Center. Always an honor to host you, Thomas. Good to have you back on the show. Thanks for being here.
Glad to be back, and thank you for having me. Sure.
Yes. Let's start by talking about whether or not we're getting a recession. That's been the debate du jour. Certainly this week. Take a look at my screen here. I was talking to you offline about this. Retail sales jumped by most in 2 years on car buying rush. Certainly, if you look at some of the most recent data, it doesn't seem that way. Here's an example. U.S. retail sales rose substantially in March on a jump in car purchases, suggesting consumers are scrambling to get ahead of punitive auto tariffs. I don't know if this is a good sign for economic growth or people are just, as this article suggests, scrambling. What's your read on this? Month to month, up 1.4%.
Right. In X autos, I think it was 0.5%.
Yes.
So this is basically described correctly. I think it is in anticipation of the tariffs that are coming and seem inevitable, depending on which day it is, I guess. But I think people are scrambling. They're trying to get ahead of the uncertainty as much as the tariffs, in the sense that when you don't know what things are going to do, if you're already thinking about buying a car, you buy one. But that's not necessarily a sign that the economy is going to be strong at all, given the fact that we have a very uncertain world that we live in right now.
Well, it certainly indicates that consumers still have spending power if they're able to just jump and buy a car now.
First of all, I would tell you that, of course, they right now have spending power. The unemployment rate is still, very close to 4%, just a little bit above it. The economy is so far has shown to be strong in the sense of low employment, good earnings. The earnings coming out in corporations is very strong. So yeah, right now things are, shall we say, good in the sense of what's happened in the past. But what people are afraid of is what may happen in the future, and that's where the economy will rest.
It says here, 11 of the report's 13 categories posting increases. Sales of building materials, sporting goods, and electronics climbed as well. Several surveys of consumer attitudes have plunged. As you'll recall, Mr. Hoenig, the last consumer sentiment survey from the University of Michigan was dramatically lower than the previous month. People are concerned about inflation. Should they be concerned about inflation is my question.
I think certainly they should be concerned about inflation for several reasons. Number one, it's already above the long-term goal, which is 2% and high enough by itself. Number two, the tariffs are going to affect prices. They have to, and they'll have to absorb that. Now, whether that's continued inflation beyond that will depend on several things. Those several things include what monetary policy does in reaction to the higher prices from tariffs and what they're going to do about being above their target right now. So that's a very important factor. So I think people are that's why they're uncertain. What is this all going to mean to them? And so while things are strong right now, and I hope they continue strong, there are a lot of uncertainties and what we'll call headwinds for the economy over the next year. Now, certainly, I don't expect that we would have a recession in the first half of the year. You still have a lot of momentum carrying forward. However, once you get past that and these tariffs start to take effect and the tariff wars intensify, then I think we are at least vulnerable to a recession.
This came in just overnight. I'll show you my screen one more time. The White House announced that China now faces 245% tariff on imports to the U.S. as a result of its retaliatory actions. Previously, it was 145. It just jumped up 100% overnight.
Yeah.
Surely China is going to do something about this. This just came in last night, so we're still waiting for China's official response. The stock markets are down today. The S&P is down about 1.2%, presumably on this news. I just wonder how far this could go. I mean, at this point, why not make it 5,000%? You know.
Well, that's how tariff wars work. That's how wars work. You escalate until someone is broken. And I'm not quite sure how this is going to end, but I do know historically, trade wars have ended badly for both parties. So we are at risk around these trade wars. I understand the desire to get your trade balance improved, but I think doing it in what I'll call a hammer-like fashion is probably short-term in its ability to deliver any real long-term outcomes. You may get some immediate effects, but in the long run, I think our economy and their economy both will be harmed. I don't know about the rest of the world because we're still moving tariffs up and down with the rest of the world, but this is really a questionable way to address your trade balance.
It's interesting. A lot of other trading partners did not retaliate, and Trump lowered those tariffs to 10% and then went back to the negotiating table. Are you surprised that China did not follow that course of action and instead retaliated tit for tat?
I'm not necessarily surprised. They're the second largest economy right now. They are not a small country like Vietnam. They have, and they're trying to develop relationships beyond the United States. They're trying to form coalitions in East Asia. They're getting countries to focus in on their currency and their exchange rate, and shall we say, move towards that exchange rate. They're trying to assert themselves. So no, I'm not a bit surprised that they would challenge the United States at this point. And you can see it in the sense of, the United States. One of the things the United States has to be sensitive to is it has a huge debt to deal with. And China holds a lot of that. The rest of the world holds a lot of that. So how they treat those countries may affect their willingness to hold dollars. And that affects our financing of our own national debt. So they're not without their own tools, and we need to be mindful of that. We need to think not just from our perspective, but from their perspective if we're going to engage in a trade standoff with China or anyone else for that matter.
You said earlier that trade wars and any wars, they escalate to the point where somebody breaks. If you had to guess, what would happen? Who's going to break first?
I have no idea who's going to break first. I think both of us are going to lose. So it's a matter of who wants to lose the most, and you have two individuals who are taking it upon themselves to decide these things, and they'll have to resolve it, unless the Congress steps in as it can and should.
Do you think there's going to be a permanent shift in the global supply chains after this?
I certainly do. I think not only because the United States wants to onshore more, but because other countries, they're not sure of their position with the United States. Europe's not all that sure of themselves. Certainly Canada and Mexico aren't. So I think you will see some changes. I think part of that is what the administration, the Trump administration wants. They want to redirect the supply chain to within the United States borders. That takes time, it takes money, and it takes patience.
How do you think the budget in the U.S. Deficit and or surplus would be impacted by the trade war? I don't think the CBO has changed its outlook by much since the last time they came out with a report, but maybe I'm wrong. What is your take on whether or not the budget will have to change?
Well, I don't know if the budget will have to change. I think it has consequences. Right now, there's no budget. All the discussion we've seen in both the House and the Senate suggest that the deficit will go up over the next 10 years significantly, as high as 7% of GDP. So how are we going to finance that? Well, we have financed it, I would say, through our basically importing capital from the rest of the world based on our avid consumption. They hold a lot of that debt. Will they continue to buy that debt? That's a big question mark now with this trade war going on. If they don't buy it, that means U.S. domestic individuals who hold dollars will have to finance it. That's the banks. That's other individuals within this country. That means greater supply to them versus the rest of the world. That means there'll be upward pressure on interest rates. That'll put pressure on the Federal Reserve to monetize some of that debt, to bring that debt onto its balance sheet, or facilitate the banking industry's ability to warehouse that debt. That means the risk of inflation down the road. So there's all kinds of scenarios that this administration and the Federal Reserve and the Congress have to take into account as they proceed with their spending and borrowing outlook for the future.
Could they have, well, is it possible that taxes would rise to offset any losses from the government if they realize less trading volume, let's say?
Well, taxes certainly are going to go up for imports. We know that that's what a tariff is. But all the estimates I've seen so far is that those taxes will not address the growing debt within the United States by itself, and we'll have to rely on borrowing from the world and from ourselves.
President Donald Trump floated the idea on the campaign trail that perhaps he could lower, if not eliminate, income taxes altogether because he would supplement that with tariffs. Is that what's happening?
Well, good luck with that one. You can't raise enough. I mean, if you raise taxes that much to fund your debt, and they've already raised, based on what they've raised so far, we're talking $500 billion when our new debt this year is $2 trillion. If you look what the Congress is doing, they're actually going to decrease taxes elsewhere. So whether these tariffs could even make up that difference is questionable. So it's got to be thought more broadly than relying just on tariffs. You have to think about spending cuts, and then do you think about other taxes? And we're thinking about tax cuts, not tax increases. So I don't see tariffs as a solution.
Okay.
If you put tariffs on heavily enough, you'll slow the economy. If you go into a recession, your deficit will only go up.
Well, let's take a look at what tariffs may do to the unemployment rate and inflation and what the Fed should do. This is a comment from Christopher Waller. He said that Trump should probably, if Trump were to follow through on escalating a trade war, the Federal Reserve may need to cut interest rates sharply to prop up the economy. He also said that if Trump applies big reciprocal tariffs after the pause, U.S. economic growth would slow to a crawl, while the unemployment rate would rise significantly from 4.2% to 5% next year. So three points that I'd like you to address, please. The unemployment rate rising to 5%, economic growth slowing to a crawl, and the Fed having to cut interest rates by a lot.
Well, those are all related. And I think if you get in terms of a global trade war, you are risking slowing down the economy, raising unemployment, and that puts pressure on the Fed to cut interest rates. The problem with cutting interest rates is that you are going to also risk increasing inflation, and they know that. They know the history of the 1970s when we did that, so they're well aware of it. So I think, and now the other side of that is, if this budget, as so far been discussed, were to be passed, with the tax cuts, the additional tax cuts, continuation of past tax cuts, and increase of new tax cuts, that will be stimulative. So that would offset the slowdown of the economy, but whether it would be enough to offset the tariff effects is questionable. So you could have a stimulated economy in one sense, a Fed that's printing money to keep the economy going and to complement the fiscal policy that would raise inflation. That is a tax in and of itself. It's a very regressive tax, that we would deal with, and you would make the economy worse off in the long run. When I say long run, I mean 2026, 2027, and beyond.
Why would it, just theoretically speaking, why would the unemployment rate go up when tariffs are being implemented?
Well, because first of all, it's like any tax increase. So there are a lot of companies that import from around the world,
Mhm.
and with higher tariffs, their cost of production goes up, the prices go up, demand goes down. They are have to lay off. People's income falls. I mean, it's a typical recession scenario. The economy slows, demand slows. You might temporarily or artificially try to raise that. That puts inflation up. That means you can't continue those policies, and you continue to slow the economy into a recession. With these tariffs, you end up worse off than you were.
I guess the Phillips curve doesn't work or doesn't apply here. It's an inverse relationship between unemployment and inflation. If I remember correctly, it means if inflation goes up or is higher, the unemployment rate should be lower and vice versa. But right
Uh,
now, we're seeing a situation where both could be high.
Well, the Phillips curve has not been a reliable indicator of the trade-off between inflation and employment
Mhm.
uh, over the decades. In certain circumstances, there's a correlation. In others, there's no correlation. The fact of the matter is, if you increase taxes, whether they're taxes, income taxes, or they're sales taxes, or they're tariff taxes, you will you take money out of the private economy, out of consumers' hands, and therefore you will slow the economy. Now, you can put that back in through fiscal stimulus, but whether you get a one-for-one trade-off is a real question mark. And generally, when you're in a tariff war, you raise prices, slow the economy, and unemployment grows.
Well, Tom, if you were still back at the Fed, what are the major data points that you would look at to determine the next course of action for the FOMC? Like you mentioned earlier, the Fed is aware that if they lower rates by too much, inflation could spike. But at the same time, the unemployment rate is probably going to go up.
Well, if I were at if I were at the Fed right now, I would be saying hold steady. First of all, tariffs are external; they're not created by the Fed. They should pass through. You will have a slowdown, but by stimulating, you only increase inflation. You're already above your target. So this is what the administration wants. It's a fiscal matter. So if they're going to raise taxes on imports, and they're going to lower taxes on other goods, will the economy get through that without a recession? I'd have to wait and see. I certainly wouldn't lower I certainly wouldn't lower interest rates or stimulate the economy from monetary policy, because the odds are I'm going to cause further inflation, and I'm not even at my target yet.
Hmm.
I'm still close to 3% using the CPI, and that means we're taxing the people at a 3% rate. It's a regressive tax. Why would we do that when lowering rates wouldn't necessarily even improve the economy?
Well, why would it not improve the economy necessarily if you lower rates today, let's say? Would it not just,
Okay,
alleviate some of the fears of the people who, who probably need lower rates right now?
who would that be? Right now, you have unemployment that's close to 4%. You have earnings that are very strong. You have strong demand for resources. So you lower the interest rate in anticipation. You increase the demand. You increase inflation. The tariffs come on. You still have a further increase in inflation from the tariffs. You still have a slowdown in the economy. And then what are you going to do? Lower interest rates more to stimulate the economy artificially? That's what they did in the 70s. And when they were done, they had 14% inflation, 14%. And before it was over with, they had to raise rates to 20% to reduce the inflation in the economy. It's a bad policy.
Okay. Should the Fed disengage from quantitative tightening right now?
It already has. It's down to a very small part. It will be under a lot of pressure to disengage further because we have a lot of debt to fund. The Fed, the OCC, the Treasury are pushing very hard, or at least the Treasury is pushing very hard, and the OCC and the Federal Reserve appear to be on board, and certainly the FDIC, and that is to eliminate any capital requirements on holding of treasuries. either risk-weighted or leverage ratio. That is designed specifically to allow the banking industry to absorb more debt without having to use capital of their own money to do so. That is a big windfall to the banking industry. It helps fund the debt, and it doesn't change the economics of it one bit.
So stand pat for now would be your recommendation. One more piece of news kind of related to the Fed that I wanted you to address. This is kind of interesting. How a Supreme Court ruling could weaken Fed independence. Justices are revisiting Humphrey's executor, a decision barring presidents from firing certain federal officials for purely political reasons.
Right.
I'll just read the first two paragraphs here. Investors are already fretting about the safety of the dollar. The court is about to take up a question that, while not directly about the Federal Reserve, could determine whether or not President Trump can fire the Fed chair. This goes back to a 1935 precedent.
Yes.
Yes. What are your thoughts about this? Hasn't been passed, obviously, but they're considering it.
I'm aware of it. I think it's a huge risk for the Fed. If the Supreme Court upholds the firing of these, independent directors, that means they are vulnerable, and it probably will be tested. I think that will shake the markets up very much, because then it's telling the world that the Fed will now be political, and they'll take one layer of, shall we say, stability out of the market, and I think that will be disruptive. So even if the Supreme Court allows these independent directors to be fired, certainly the world will then expect that the Fed will be challenged in its appointments, and that will by itself create disruption. And if then the Supreme Court were to take it on and rule, then I think then the Fed becomes a pure political body.
Is there any historical precedence of that happening, the Fed becoming a political body?
No, not. There's none. There's no historical experience where the independence of the Fed has been challenged. Now, it has been challenged. Some parts of it have been challenged, whether the presidents can be FOMC members in that, and the courts have always upheld the Federal Reserve Act to do that. But I don't know of any instance where there's been a specific effort to remove the independence of the Board of Governors and the FOMC by any president.
Okay, so just to be clear for the audience watching, so let's say the president makes a public remark, like he has been doing, saying that the interest rate should be much lower. The Fed is not obligated legally to respond in any way?
That's correct. They are not obligated to respond in any way, and in past they have not done so.
Mm-hmm.
If they fired the Board of the FOMC or tried to, and they were successful, then they would have to listen, and I think it would become a pure political body.
What if the president and or members of his cabinet were to sit on the FOMC, which is something else that Trump suggested last year? What do you think of that idea?
Well, historically, that has been done. The Secretary of the Treasury did sit on the Board of Governors prior to the Great Depression. That was changed because they wanted more political independence, I suspect, for it. But we would return to that model or more so.
Okay. Finally, Thomas, how will the financial institutions, banks, be impacted by this trade war?
Well, I think in a couple of ways. Number one, if the economy slows, they have a lot of loans that they need to be aware of, business loans. Those businesses will be affected. That means their portfolio will be affected. So that's one very important way. Now, I assume those are high quality loans, but in a recession, loans deteriorate. That's just a fact. So that's number one. Number two, the trade war makes the financing of our debt more difficult. And that means they will turn to the banks, especially the primary dealers, to make sure that the auctions for debt are successful.
Consumer loan delinquencies are going up. How well capitalized are the banks now to withstand perhaps even higher levels of delinquencies if the situation deteriorates?
Well, the banks, I mean, everyone, you ask any official, they're well capitalized, but the banks are marginally capitalized. If you look at their total capital to assets, their total capital to assets on a book basis is around 7%. So they can absorb losses. If they absorb more than 2 or 3 percentage points of that, the public will become more unsure of their financial safety. Those are risks that are out there. But at the moment, they're certainly better capitalized than they were in the great financial crisis to start with. But they're not, I'm not going to sit here and say, oh, they're well capitalized. They're better capitalized. They should be able to withstand this. But if we have a major trade war and a major recession, well, they're going to be put under pressure.
And I guess the last question to sum up everything we talked about, do you think we're getting a recession this year?
Well, we're not going to get a recession in the first half of the year. I think whether we have one in the second half is yet to be determined.
Okay.
And what will determine it is how deep the trade war goes, how broad the trade war goes, and then how well our economy withstands the uncertainty as we transition to whether we have a trade war continuing or not.
Great. I thank you for your time today, Thomas. It was great to catch up and talk to you again. Where can we learn from you and follow your work?
I'm at Mercatus.org.
Okay. We'll put the link down below, so make sure to follow Thomas Hoenig in the Mercatus Center there. Appreciate it, Thomas. I look forward to speaking with you next time. Take care.
Look forward to it as well. Thanks, David. Good to be with you.
Thank you. And thank you for watching. Don't forget to like and subscribe.